Well, thank you very much indeed to the association and happy birthday. But it's tinged with regret because they've gone and put me on after Chris Smith. And how can you look good after he's just delivered such thoughtful remarks, and particularly in Spanish? Thank you, Chris. By now, you've probably noticed that I'm not Saudi Arabian. But I'm going to do my best to make up for that by offering some insights from the perspective of what's going on, particularly in the Gulf region, and how this game might play out. Before I came, I did what I always do. I ran the ideas for my speech past my wife, and she gave me the same advice she always gives me, which is be interesting and be brief. But if you can only manage one of those things, then choose to be brief. So I'm going to try and do that, but I sat through yesterday's sessions. I'm very glad I did. There was a lot of provocation, a lot of interesting stuff going on. And so I thought before I dive into what's going on with OPEC and OECD responses, I thought I might just reflect a little bit on some of the themes that came up yesterday. The first was that the range of potential oil prices that were seen in the near and even the long-term future were very wide. I think someone even said, you know, if the range is between $30 and $130 a barrel, that's not much use. As I'm going to come back to in my own remarks, I'm going to say that's an extremely useful insight. Because what it's telling you is you have no idea what the oil price is going to be, and that you need to develop a strategy. Whether you're a policymaker or a commercial entity, you must develop a strategy that is resilient to the entire range of potential outcomes. And that may be one that is uncomfortable, but it's a necessity. Isn't it funny how when people tell you that they have no idea what the oil price is going to be and that the oil price is intrinsically impossible to predict, they then go on to predict it. I'm absolutely not going to do that. If I look as if I'm going to do it, then I give permission to anyone to come and tear me off the stage. The second thing that came up yesterday was this discussion about government take and competitiveness. And I'm going to disagree with this obsession with government take. I have, during my career, sat in quite a lot of boardrooms, and I've never heard boards of directors agonize about government take. They generally focus on company take. Competitiveness is not defined, as far as investors are concerned, by the level of government take. Given the choice between two investments, one that has an 80% marginal tax rate but delivers a 20% rate of return, or another that has a 50% marginal tax rate but delivers a 10% rate of return, I know which one most boards of directors will select. Doesn't mean that government take is irrelevant, and it'll be important, again, I'll come back to, because it is the simple measure that allows populations to judge the legitimacy of the stewardship of the resource by their governments. But please don't think that if you make sure that your government take is competitive with the government take of your neighbors and your competitor resource holders, that that's the problem solved. Unfortunately, the resource endowments in different countries are not always the same. The third thing that I sensed yesterday was this notion that companies have to invest and governments have to accept investment. Governments and companies, subject obviously to contracts they might already have entered into, are volunteers. What that means is that carrots rather than sticks are the order of the day. Doesn't mean occasionally you won't get hit with a carrot, but it does mean that you are more likely to achieve success by inducing them to the behavior you want rather than trying to browbeat them into it. Appointing expert panels to talk about what ought to happen is always proven wrong by the market. We only have to look at the Alberta royalty review of several years ago, royalty reviews or fiscal reviews in other places. In the end, the only thing that speaks truth about what is competitive is the capital budget of the investor. There was the energy economics equivalent of weapons of mass destruction put up on the screen yesterday. I don't know when break-even price curves became the vogue. They started out being the price necessary for the investor to break even and became this surrogate for the supply cost curve. And then people started to do the fiscal break-even for resource holders. What's the oil price that allowed them to balance their budget? I calculated it for the United States. It turns out that at $1,150 per barrel, the US budget can be balanced. So for as long as oil prices are less than $1,150 a barrel, clearly the US is an unsustainable economy. This is complete and utter tosh. I apologize to the translators or the interpreters. I'm not sure how you're going to deal with this. But it comes from this willful confusion of dollars per barrel of cost to dollars per barrel of break-even price, even dollars per barrel per day of capacity. In the end, one of the largest costs in all of these calculations are the discretionary decisions that governments take. Whether it is capital investment programs, and strangely enough, when oil prices are low, countries that are reliant on oil revenues tend to cut back their capital programs. Companies tend to do the same as well. So this notion that somehow there is a fixed cost and there is an inability to run deficits and to adjust your costs, I wouldn't rely upon that as a support for oil prices. So talking about the need to maintain competitiveness through the fiscal terms, governments implicitly realize that. Sometimes they use this wrong metric of saying, well, if I've got a 70% fiscal take and Venezuela's at 80%, that makes me competitive by comparison. But it's the return to the government, the return to the investor that matters. And in fact, even that, once you've maximized the fiscal take, that may well be the wrong metric as well. Because what resource-holding governments are seeking to do is maximize the societal benefit of the development of that resource. And that means including the value of activity, the value of investment, the employment that's generated, the economic spillovers, even the economic diversification that can arise from the investment in resource development. But governments are faced with a problem. In my old job as a consultant, we used to sometimes play fantasy oil company executive. It was always possible to look at the decisions of executives in major oil companies that had gone horribly wrong and to point out how almost every decision, a better decision, could have been made. Unfortunately, those same major oil companies seem to have been around for an awfully long time, and so we can only make one of two conclusions. Either making bad decisions is a competitive advantage, unlikely, or what we don't notice is that they make an awful lot of not quite the best decisions, but on average, their decisions are pretty good, and they seem to survive and thrive better than an awful lot of the smarter, nimbler, smaller companies over time. Well, governments have to live in this range of political legitimacy as well. And if the fiscal terms necessary to precipitate investment result in a government take that doesn't look competitive, then you end up with a problem of the political legitimacy being able to drive it through. And this requires a deep thinking about how you sell, how you encourage a population to accept the decisions that are made in a world where increasingly populations feel less and less bound by the decisions their governments make. And that applies almost universally around the world. So I'm going to come back to what all that means for Colombia in a moment at the end of my remarks, but those were the reflections I got from yesterday, and they sort of feed into the main theme of what I was intending to talk to you about today. We're 1 year in, and so it's a good idea to ask, how's it all going so far? Since a decision not to do something, which everyone interpreted as a decision to do something, what do I mean? The world assumed that Saudi Arabia, more specifically, but the Gulf OPEC countries were not being honest when they said they didn't intend to cut production in order to support the oil price. The notion of this OPEC put that would somehow support the oil price for a long period of time suddenly evaporated in November last year when everyone expected them to cut and they didn't cut. It's the first time that not doing something turns out to be a really aggressive action that brings recrimination. Well, where are we today? We're probably in 1987. The difference is that in 1986, Saudi Arabia particularly had endured 5 years of declining revenue because it had cut in order to try and support the price even as the price came down. This time around, the Gulf OPEC members decided that they wouldn't endure 5 years of pain before the market shakeout happened. They decided to let the market shakeout happen on its own. They decided to let the market do a test to work out where oil prices should be in order to balance supply and demand. 1 year in, 1987, are we faced with another secular decade as we did during the 90s, or are we faced with some earlier return? I have no idea, and I promised you that I wouldn't profess to have any idea. People talk about OPEC. I'm going to tell you that that is too simple a label. Labels are wonderful things because they allow you to talk about something fairly complicated in shorthand, but sometimes labels become misleading. There are two parts to OPEC. There are those who have large populations relative to their production, and there are those who have small populations relative to their production. And if you have a large population, you can produce an awful lot of oil and still not generate enough revenue to live the American dream. $500 doesn't buy you, per year, doesn't buy you the American dream. But that's what the per capita revenues of a number of OPEC producers are. The ones with small populations are able to meet their budget requirements and invest for the future and provide some kind of stabilization because they've got revenues that amount to thousands or even tens of thousands of dollars per capita. So we see this split between Venezuela, maybe Ecuador, Iran, Algeria, and the OPEC members in the GCC who are much better able, especially as they might even be able to run deficits for a period of time, to withstand a long period of low oil prices. How long? I don't know. So who are the targets of this market test? Well, it's often talked about US shale or shale oil being the target, but I'm going to suggest to you that no one could reasonably expect that to have been the target or the victim of a market test of oil prices. The reason being that costs are a function of price rather than price is a function of cost. It's not a single one-way relationship, there's a feedback between them. But anecdotally, let me suggest to you that 2 or 3 years ago, if you could drive a large truck and you were prepared to live in North Dakota, you could earn $150,000 a year. And if you wanted to pursue the same profession in Oklahoma, you could only earn $75,000 a year. There wasn't something intrinsically more valuable about North Dakotan truck drivers, it's just they were in short supply and they had leverage. As prices have come down, those same truck drivers seem to be able to survive on less than $150,000 a year. 4 years ago, welders in Australia went on strike because a 32-week year earning $385,000 a year was insufficient. They wanted a 28-week year earning $425,000 a year. It turns out that my attempts to persuade my children to go and become welders were thwarted by Australia's requirement for a 7 or 8 year apprenticeship before you could become such a welder. Again, leverage in negotiations. So what we're seeing in the North American shale plays is a switch from the full cycle cost necessary to precipitate the building of new rigs, new frac spreads, that sort of thing, to the short run costs where service operators decide that it's better to be operating than not operating. I know of companies in which I'm invested where the price that they've secured their drilling rig for 2015 and 2016 is about half what they would have paid if they'd tried to contract the same rig in 2013, 2014. So you're seeing costs come down as a result of both deflation in costs, but also people being more efficient. And what you find is that productivity gains in the shale plays will contribute to a continuing lowering of the break-even cost, whatever that particular number means. Assets don't know who owns them. They have no idea whether their owners are solvent or not. And when the current owner of an asset becomes insolvent, the new owner takes over, and the asset doesn't stop producing. So to expect the bankruptcy of the owners of assets to cause a reduction in production from those same assets requires either that we move from this notion of smart fields or the digital oil field into sentient fields, and I think we're not there yet, unless Ray Kurzweil knows something that I don't know. The concept of sunk costs has not been abolished just because OPEC has not cut production. So the short-term nature of investment and returns in shale will allow shale to survive because it will drill off the curve. If the future price of oil over the next 2 years can be hedged at a price that locks in returns above the costs of that activity, then that activity will happen. The real target of the market price test is almost certainly the long-term unhedgeable projects, the ones that have a 5-year development time frame and then have a 7 to 10-year payback time frame, and you cannot hedge that length of tenor. So who are they? Well, they're probably deep water developments in some places. They're probably Arctic developments. They're almost certainly remote locations, maybe even LNG projects if LNG continues to piggyback off oil prices as a way of setting the price of its product. I would advise you to look again at the slide shown this morning with the ConocoPhillips budget. It was a really revealing thing. Companies cut back what they can cut back initially, and that's normally short-term capital expenditures, but in the longer run, they cut back what they want to cut back. And if you saw the long-term large investments were what was shrunk by, what was it, 45%, I think, between 2015 and 2017. That's as long-term investments come off the books. They don't get replaced by other long-term investments. They get replaced by short-term investments that can be more resilient to the environment in which we find ourselves. In the good old days, that's probably Victorian Britain, children, well, for the purposes of what I'm about to say, it was Victorian Britain. I gather there was lots not to commend about Victorian Britain. But the way children were taught their multiplication tables was that they were beaten. They would say their multiplication table and then they would be caned. We've become more enlightened. We now inflict psychological torture on our children rather than physical torture. We tell them how disappointed we are rather than how angry we are when they bring home their grade card. But the industry during the 1990s behaved a little bit like Victorian children. Even though the oil price averaged just shy of $20 a barrel during that period, most companies told their investors how resilient their developments were to $10, $12, or at worst $14 oil. They invested as if they remembered the slap around the face that they got in the late 80s, and it's quite possible that that's what we'll see this time around, that the industry is the recipient of this hearty slap around the face that oil prices can be $40, maybe, who knows, before this is over $30 a barrel, and that they will be investing as if it could be as low as that even if prices recover. The only certainty is that prices will only recover when everyone has given up hope. The more people I hear say it's going to be lower for longer, the more optimistic I become that oil prices are going to recover because they will cut back their investment and that will lead to the conditions for the long term. It turns out the only way to predict oil prices successfully is to be the only person in the world who believes your forecast. Unfortunately, that's not a very commercial proposition if you're trying to sell oil price forecasts. Anyhow, what does it mean in terms of OECD demand? Well, the first thing is it depends on how you spend your windfall. It looks like American consumers are starting to spend the windfall of lower energy prices. European consumers, well, they're stuck in this hellish experiment to see how much poison an economy can consume without ultimately dying. And so most of the windfall is being consumed in paying down debt or hunkering down for a rainy day. But maybe more interesting is what's happening on OECD supply. And by that, what I mean is really what's happening in terms of OECD competitors to fossil fuels. We heard yesterday with extraordinary precision that in the UK, renewable energy was going to become cheaper than fossil fuel in 2018. I was hoping for a month and maybe a day within the month, but that's just not the way these things are done. But I'm going to tell you that's just not how it happens. We're engaged in a world where potentially policymakers are for the first time going to cause a decline in demand for fossil fuels. What you may or may not know is that last year the world consumed more biomass than it's ever consumed before, despite the transition away from biomass when coal arrived on the scene. We consume more coal than we've ever consumed before, despite apparently transitioning away from coal with oil and gas. We consume more oil than we've ever consumed before, and we consume more gas than we've ever consumed before. Transitions in the past have been supplementing or augmentation as a legacy fuel migrated into a higher value niche. But for the first time, we're in a policy world where the intention is to reduce demand in absolute terms for fossil fuels. How many of you, and I'll invite you to stand up, if you believe that oil prices, if we took out 10 million barrels a day of oil demand, how many of you believe that oil prices would be more than $10 a barrel? I don't see many people standing other than someone running to leave the room, and he's probably the only smart one here. The point about it is that two things will happen if transition policy is successful. We will move down the cost curve, and it's an exponential cost curve. When we get down a few million barrels, we end up in quite a low cost, especially if governments cut their fiscal take to remain competitiveness. And secondly, the cost curve itself will move down because innovation happens not just in new entrant technologies, but it happens in incumbent technologies as well. And we've seen that. Tight gas in the United States is cheaper to develop than the conventional gas. That's the reason that the rate of decline of conventional gas has accelerated even as the supply of tight gas has grown exponentially. So we have to break out of this fantasy utopian view of transitions where the exponentially declining new entrant meets the inexorably rising legacy fuel and the crossover happens between 3 and 5 years from now. And we only have to have the courage to support policy for the next 3 to 5 years, and we can cost the gap between those two lines. Well, in 2005, wind power in the United States was break even without any subsidy with natural gas-fired power. Today, that gap has opened back out again because natural gas has become cheaper and because actually for a period, wind power became more expensive because of the supply chains not being deep enough to support the demand for this now competitive source. Transitions take much longer. They require a much more sophisticated approach to ensuring that the long-term nature is accepted and legitimized in the eyes of a population who are going to pay. Because there are only 3 sources of money in the world. There are investors, and investors stop investing when they don't get returns. There are taxpayers, and taxpayers vote governments out when they tax them too much. And then there are consumers. And consumers, well, unfortunately, they're mostly voters as well. So you end up in a situation where there's no magic 4th pot of money that you can fund this transition. You need to arrange, and low oil prices and low gas prices and low coal prices are going to open up the gap and force the policy cost to be borne, probably by a combination of consumers and taxpayers, for a much longer period than maybe is being assumed. There may be a short-term magical 4th pot of money. Sometimes policymakers just steal the equity of the incumbent utilities, and that's what's happened in Germany, where E.ON and RWE and others have effectively had their equity value handed over to renewable development in terms of the policy support. But what it means is that there is going to be probably a slowing in the rate of transition unless policy later this year turns that around and, if you like, entrenches the likelihood of falling demand. And if we see falling demand over the long run, then we're at the start of a secular change in the price of oil and gas, but not necessarily in the returns of investors and governments in oil and gas, because costs are likely to be reflective of that. So it brings me back then, if we are at the start of this secular change, what does Colombia do? Because apparently that's what I have to tell you as my punchline. My punchline is definitely invest in the national soccer team. Nothing makes a country feel better than winning the World Cup. I'm just old enough to remember that, and I really haven't felt good for 50 years. But there are two obvious things that Colombia can do. One costs you money, and that is to maintain competitiveness by adjusting your fiscal terms preemptively, because once you lose investors, it's harder to get them back. And the second thing you can do that doesn't cost you any money, but does save money for your investors and makes you a more attractive place, is you can shorten the time frames. You can reduce the transactional frictions. You can do the things as governments and as policymakers to smooth the path by doing wide area environmental baseline surveys, by preparing the ground with local communities, not stepping back and saying, well, that's a problem for the companies to deal with, but by proactively engaging and telling the message about how investment in natural resources is good for the economy, it's good for societal welfare, and it's something that is ultimately good for Colombia. And if you can reduce those time frames, then you create value that you can share with your investors, and that, more than anything, provides sustainable competitive advantage. So if there's one thing that Colombia can do, it is give time to your investors. Thank you.